Happy Friday, traders. So we saw a big disappointment in US jobs data today, and despite that, the dollar has not sold off significantly, even though the headline jobs print was negative 23,000 against expectations of 85,000. And there was some big downward revisions for the previous 2 months. So why is the US dollar not falling more significantly? Well, part of the reason is the fact that the Fed's focus now turned more on inflation than on employment. And on that front, we have CPI coming up next week and another one before the next Fed meeting, while crude oil prices continue to remain supported on the dips, given the lack of any deal that we were promised to see, which hasn't materialized so far this week. And with the weekend risk approaching, traders are not taking any chances, and oil is bouncing slightly off its earlier lows after yesterday climbing above the 200-day moving average, as you can see on this daily time frame. So the lack of a more significant drop in the US dollar is twofold. First is to do with concerns about re-escalation in the Middle East conflict, and secondly, the focus for the Fed and the markets have turned more towards inflation data than employment, which makes next week's CPI release all the more important. Following the weaker than expected US jobs report, the dollar Swiss fell to test this area of key support around 80.40 to 80.60, an area which was previously resistance, as you can see on this daily time frame. This zone has since turned into support on a number of occasions, and we've tested this same location once more today, and the dollar Swiss is bouncing back from its earlier lows at the time of this recording. The dollar Swiss could remain supported owing to the fact that interest rates in Switzerland are at zero, while in the US, expectations for some policy tightening continue to support the US dollar on the dips, despite the fact that we've seen a weaker than expected jobs report today. The next levels of resistance to watch include 81 and then 81.32, levels that were previously support and resistance. Gold extended its rally after the US jobs report came out much weaker than expected, and as a result, we've seen the precious metal rise to test this area of important resistance between 4,366 to 4,400-ish zone, which was previously support. As you can see, we've tested this zone previously in mid-June, where gold last sold off from. We've now come all the way back to the same level once more, and the key question now is whether gold will be able to climb above the zone or whether we'll see a bit of a pullback. Zooming in a little bit, we can define our levels more precisely. The high from yesterday comes in at 4,300-ish. That would be the first level of support. Below that, we have the high from that big thrust candle that led to the breakout from this consolidation zone. The high of that candle comes in at 4,267. So those are the next levels of potential supports on gold. If those levels now fail to hold, then that would be a bearish development, in which case gold could well return back to the point of origin of the breakout around the 4,100 area, shaded in gray right here. The line in the sand for me now is the low from this big candle from Wednesday. The low of that comes in at 4,065, and should gold break through that level in the coming days, at that point gold will turn quite bearish, because this would point to a false breakout scenario. Thanks for watching. Don't forget to like and share this video, and for more market updates, head over to the news and analysis section of our website at FOREX.com. See you in the next update.